We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is J.E.S. He's the author of The Real Truth About Inflation. Thanks for joining me today, J.E.S.
Absolutely, Tom. Thank you so much for having me. I love your show, and it's a real pleasure to be here with you.
Well, it's a pleasure to speak with you too. And like I said, you're the author of a book called The Real Truth About Inflation. And going through it was quite interesting to me. And there's so many different points that you pick up on. And I think it's a really well-written book, kind of a different style than most people are used to. But I think that that's valuable because there's value in trying to look at things from different viewpoints, as I've said many times on the show here. So who is, let's say, your main audience that you're hoping to inspire and or educate with this book?
So that's a little bit of a challenging question to answer because there's a multitude of degrees by which I want to kind of enlighten, sort of, if I can use that word, individuals that may already know aspects about this topic, this field of topics, and at the same time also try to reach people that have never even begin to question these fields, because so much of what I talk about is things that people kind of know on the surface, but they're not substantially aware of at deeper levels. So things like money and currency and inflation and government, economics as a whole, are things that kind of exist in the background of our day-to-day lives, but we don't really understand the deeper implications of how they affect us. And so I definitely want it to be for people that have an interest in these subjects and these fields. But I also really wrote the book for the average American who doesn't know anything, or I say average American, and I know that a large portion of your audience is not American, and it's for them as well, but specifically the Americans, because I find that Americans tend to be the most uneducated about these matters, perhaps due to the reserve currency status that kind of puts them in a blinder spot location with this field of subjects, because they're so sort of numb to the realities of what being a country holding the reserve currency status in a fiat world predicates in terms of their view of how they respond to these understandings. So for the most part, I would say I wrote it for the average uneducated American, not really, and I say uneducated in these fields, that doesn't really know a whole lot about them. And it's really, more than anything, an introductory book to the concepts that exist in our daily lives, but we know very little about at deeper levels.
Mm-hmm. So why don't we kind of start there? You do introduce a lot of different topics in the book. So since definitions matter and we want to be precise, why don't we start by defining the word inflation?
Yeah. And I did an interview with Chris Marcus over at Arcadia Economics, and I really just did a very basic understanding of the definition of inflation. Mm-hmm. And I did that to try to skip through the understanding so that we could at least target the baser acknowledgments of what it means. And I didn't mean to quantify it as being only that, but I guess inflation in itself, as I said on that interview, is an increase in the quantity of the currency supply. And historically, inflation used to mean an increase in the quantity of the money supply. And the distinction between money and currency, we'll get into in a little bit, I think. But for now, or for our purposes, it's an increase in the quantity of the currency supply. And that's not the total understanding of inflation, but it is where we want to start, because it is the premise by which inflation begins. And if we don't start there, then we've started at the incorrect point. So we'll start there, and then we'll kind of move forward through, I guess, velocity. Velocity of inflation is the circulation component by which currency, or historically money, moved through the economy. And we use the word economy to mean lots of different things as well. And so today the economy has a multitude of meanings. A lot of people like to think of the economy sort of in some, I guess, in some instances as the stock market, that's the economy, or the bond market, or the financial markets, or the real economy, the commodities part of the economy. What we mean when we say economy has a lot of distinction of meaning as well. And it's we generally tend to group these meanings of words into one conglomerate understanding that really prevents us from being able to target specificity when it comes to the usage of them. So when we talk about velocity is the circulation of currency exchanging hands. That's essentially the baser level understanding of what velocity is. And so if you take an example, if you have a 10-person economy and you have one unit of currency and you circulate that unit of currency one time around, you have a velocity of 10. And if you increase the velocity, you circulate it twice, you have a velocity of 20. Or you can get the same outcome by adding a second unit of currency, circulate it one time, and you also have a velocity of 20. And so velocity is the rate by which currency exchanges hands. And that rate impacts the price response, basically. As currency picks up speed, the component elements of the pricing mechanism start to notice that currency is circulating faster, which gives the illusion that there is more of it. And so when under basic premise of supply and demand in economics, when there's more of demand of something, the price will go up, right? So if your supply remains the same or falls and your demand goes up, your price goes up as well. And so when currency circulates at a faster rate, that signifies increased demand, which then signifies that prices should rise to follow. And that's not always accurate because velocity can be an artificial indicator of circulation. Depending on how it's circulating, there's so many variables that go into the velocity component of where certain elements of currency may be circulating in certain areas of the economy or certain components of specific elements of certain areas. I mean, there's so many things that artificially give false signals to the real actual circulation of the actual currency. And there's no good way as currently exists for us to get a secure, honest, fair determination of velocity as it's circulating. And so that's why it's a lot easier to go back to the original definition of inflation, which is just pure and simple, an increase in the quantity of the currency supply. And so that in itself is kind of a more or less than rudimentary examination of the definition of inflation. It gets even more complex as we go in further and deeper into it. And I mean, we can absolutely do that if you want to. It's just, I don't know how deep you want to go with that definition.
Well, I think the simple definition is okay for now, simply because the real distinction I kind of wanted to make there is just, are we talking about, consumer price inflation, or are we talking about growth of currency supply? It seems that we're in some interviews, one person could be referring to inflation and people take it as a completely different thing, whether it's, like I said, currency supply and or consumer prices. So I want to be kind of precise on that. But you mentioned the difference between currency and money. Is there a very distinct difference to be made there?
Yeah.
Those words are always used very interchangeably.
Yes, they are, unfortunately, because it casts a blinder type blanket net over the understanding, and it kind of leads us into an abyss of understandings that really are vastly unhelpful. So regarding price inflation, that tends to be currency based. And not that you can't have price inflation in money based economies. You can. It's just a lot more difficult. So one of the reasons that currency and money are so vastly different is that money can't be rapidly inflated. And the reason for that is because of what the definition of money in itself actually is. And money is, more than anything, money is a metric. So money is a metric, and money cannot be rapidly inflated. It can be inflated, and by inflate, we mean to increase. And so maybe that in itself needs to be addressed. The term inflation is just to increase, and deflation means to decrease, essentially. So as we increase the rate of the supply of anything, it increases in its quantity. So money is a metric, and it can't be rapidly increased because money supposedly is an unchanging metric. That's the whole concept of money. So I like to think of money not in terms of gold or silver or dollars or any of the conventional understandings by which we determine our viewpoint of money, but I like to think of money in terms of a measuring tool. So a kilometer, a yard, a meter, a foot. I'm trying to think of any constant that exists. Light is a constant, 186,000 miles per second, right? These are all constants that exist as the metric by which we measure something. And they don't change ever. They never, ever change. So money is a determinate metric by which we value something. And currency is not. It absolutely isn't, because currency can rapidly change in its quantity, right? So it would be like taking, we'll use the foot or the yard, for example. If you, let's say a yard is 36 inches, right? And if you have the equivalent understanding of a yard with currency, suddenly a yard is 75 inches, it's 112 inches, it's 4 inches, it's constantly fluctuating, making the determination of measuring impossible. And so the reason that in currency environments, especially fiat currency environments, and the distinction of that is that in a currency-based world with real money backing it, you have currency standing in as a representation for the metric of money. But in a fiat currency world, you don't have money as the staple by which all things are determined. So in a fiat currency world, the supply or the quantity can increase or decrease, rapidly changing in any direction, basically, at any given moment, which causes prices. Prices are simply information. They're information conveying input and output costs, and costs and prices are not the same. What a price is what you pay. Cost is what it takes to produce or create. And so prices are information as to a cost. And with a fiat currency-based system, the quantity of that supply can rapidly change. So you've got fluctuating metrics by which you cannot make a determination about anything relating to the price aspect of it. So when it comes to anybody, whether it's a business or an individual or a government or what have you, they cannot get accurate information regarding the things that they need, which are theoretically priced in a fluctuating constant that should not be fluctuating. Mm-hmm. Does that make sense?
Mm-hmm. So when we think about, let's say, the price of money or the price of currency, we're talking about an interest rate, basically. So how have artificially controlled interest rates introduced distortions into the market?
Yeah, it seems really almost kind of simple on its face, but it's really complicated because there are so many layers to it. And the interest rate component, theoretically, there's two sides of it, basically. So the US government issues debt in the form of treasury notes. And they issue debt I say the US government, but any government issues debt in some form or another, whether it be treasuries, US treasuries, it doesn't really matter. Their form of debt, and they issue it at an interest rate. And they basically say, if you loan us money, and how you get your money that's a web of entanglement that we could go down the rabbit hole of later. But if you loan us as the government and the issuer, you loan us money, we will pay you back your principal plus a rate of interest. And that sets an interest rate for the debt side of things. And then you have the central banks, which are supposedly independent agencies acting separate from the governments, yet somehow are pseudo government agencies that are kind of controlled by the government, yet not. And they issue currency. And currency is another form of debt. Essentially, it's a promise to pay. It's a promise of purchasing power. It's not actual money. So actual money is purchasing power, essentially. It's a little bit more complicated than that. But debt in the form of currency, the central bank issues this promise to pay a value that you can then theoretically go and exchange in the regular economy with other individuals or other agencies. So the government issues their side of the debt equation in the form of treasuries or debt on their side. And then the central banks issue currency on their side of things. And the currency is a promise to pay equivalent purchasing power of being able to transact in the economy with the means of exchange by which they determine set at some rate of exchange that quantifies your ability to acquire something in exchange of that note. So we use dollars as examples. I mean, any country that you live in that you use your currency, you can substitute your currency, but the currency note exists as the identification of the value that you're supposedly exchanging for. And so these central banks, they issue their currency also at a rate of interest that they set depending on what they feel is adequate for their rate of injection, essentially. I'm pretty sure I'm not them, and I don't really know how their inner workings work as far as the way that they make that determination. It's all hush hush with a lot of that stuff. So it's really kind of more speculative than anything. But my best guess determination on how the rate of exchange in terms of interest is assigned has to do with the amount of money or currency. I say we all, it's not uncommon for so many of us, including myself, to make that faux pas grammatically, linguistically, to call it money. And it's something that I've been spending years trying to get out of, and I encourage everyone to try to do as well. The issuance of the rate by which the amount of money, or currency that the central bank issues sets the interest rate, essentially. As much as it might seem as though the opposite is true, that the interest rate may set the amount by which they issue, it's really how much are you issuing that sets the supply. And then based on the supply, the demand will follow. And as demand follows, then they say, okay, there's this much demand, so we're going to set this rate of interest based on the amount of currency in circulation, the amount of currency issued, and the amount of demand chasing that currency. And that's going to set that interest rate. And so you've got the government side issuing their debt at their rate of interest, and you've got the central bank issuing their debt at their rate of interest. And a lot of the time, the government issues that debt and the central bank acquires it essentially at no cost of debt. So the rest of us get paid a rate of interest from the government because we're loaning them the capital that they then use to fund their deficits. And they then turn around years later or a year later or whenever that treasury maturity comes due, and they pay you your principal plus interest. So they're paying you the difference on the interest side. And so that's non-negotiable because you're the individual lending them that capital. So there's going to be interest attached to it no matter what. But the central banks, they don't need to have interest, essentially. They get these interest-free debt loans to acquire government debt at no rate of interest, and they exchange that debt for currency, which then the government takes and pays its employees or funds its deficits or whatever. And then that currency circulates in the real economy. And then, of course, we've got the conventional banks using their reserve requirement ratios to exponentially increase the total quantity supply of the actual circulating base currency, which then increases the currency supply in that regard, which then causes price inflation, which also causes real, there's elements of this that, like I said, there are layers to it that there's no easy way to talk about it. Mm-hmm. So hopefully that covered it to some degree of clarity.
Mm-hmm. So how much is the value of a dollar, Jess, dropped since 1913?
Yeah. So the whole dollar thing with the Federal Reserve, the creation of the Federal Reserve is kind of scary. And the way we look at it tends to be through the eyes of measuring gold, right? Because gold is the metric by which we determined the value of the dollar in 1913. And since then, the value of gold in dollars has dropped dramatically or risen dramatically, depending on how you're looking at it. But you have, in 1913, you have gold at $20.88 an ounce. So that's the exchange rate. And since then, you have gold up around, well, I guess recently 1,700, but, you know, we'll call it 2,000 as kind of a metric by which we kind of at least ballpark it. And so you can say that the value of, what is that? That's 1,000 times. I'm trying to do that conversion in my head, but it's basically 100%. I mean, you can look at it in terms of percentage. The value of the dollar has fallen 100%. Ballpark figure. I mean, you can call it 97, 98, 96. It really doesn't matter. Once you get past, you know, if we're gonna use grades in school, 60% is failing. Well, I think once you cross 60%, you've pretty much, you're starting to tip the favor against you in terms of it holding any measure of value. Up beyond 75%, 80, 90, it kind of becomes a moot point. So the value of the dollar since 1913 has lost all of its purchasing power, in my opinion. I mean, I'm going to generalize with the terminology of the word "all" there, but I mean, it's sufficient enough to the point where it's meaningless distinction that is irrelevant. It's nonsensical to say, okay, it's 98%. And I should, you know, we can move on from that, but the dollar in itself is valueless. It has lost 100% of its purchasing power, and you need so many of them to equate to what theoretically was supposed to be a constant. So if we look at the dollar the way we look at any other constant, whether it's gravity at 9.8 meters per second, or we look at light, or we look at a yard or a mile, it's as if a mile is now what used to be 5,280 feet is now 500,280, you know, whatever. It's so exponentially large. It's such an exponential increase in size that we can't assign this terminology of value to it anymore. A mile is no longer a mile when you increase it by 100% or a factor of 1,000 times or whatever it is. So the dollar, you know, we still use it to transact in, but you need so many of them that we can't really call them dollars anymore. I mean, we can, I guess, because the assignment of the meaning of the word is, I guess it's capable of being mutable through time, but it really doesn't hold the same meaning. And I think that's one of the distinctions that needs to change as we use this in our everyday language. Does it mean the same thing? And do we want it to mean the same thing? Do we care? Or is it just every day it's going to continue to lose its meaning and we're going to keep calling it the same thing?
Mm-hmm. So, you know, when we think of having a stable measuring stick, and we used to have the dollar tied to gold in a certain way, did that constrain governments and really dictate behavior of governments versus being unconstrained by the gold standard?
Yeah, absolutely. And I'm sure as many of your listeners know, the reason for that is because the distinction of that money currency understanding was that governments had to spend money. They couldn't spend currency. I mean, they could, and they did. And that's what got us to 1971, because we issued more currency than we had money for. And you're essentially defaulting and claiming that you have more money backing your currency. But when you're a government and you operate on the premise of using gold or a measuring stick to determine your total asset allocation of capital in terms of how much you have in purchasing power. And in purchasing power, it's a social construct, right? Because we all agree that something has the medium of exchange value by which we transact in. So something has to be agreed upon as being a stand-in representation for that measuring stick. And gold was that that metric, that stand-in, ironically, as much as we like to think of gold as money, gold is the representation of money, and fiat is the representation of money, or currency is the representation of the representation, and fiat is the representation of the representation of the representation of money, right? And it's psychotic once you start going into the deeper levels of it. But gold is this representation of it's like trying to, a yardstick is a representation of a yard. A yard is a distance, right? A yardstick is not a yard. I mean, it is, but it isn't. It only represents it. So gold is a representation of that. And so when governments operate on a fixed standard, they need to have theoretically that quantity of that representation in order to transact and in order to exchange their value and be able to claim that they can spend what they supposedly have. And when you have gold or any other metric by which we agree is the social construct that we call money, they are limited in their ability to spend beyond their means. And spending beyond your means, it has its advantages and it has its disadvantages, and the component elements of Keynesianism that exist today aren't necessarily what it was supposed to be. And I just jumped into Keynesianism, and I apologize for anybody that kind of got a mental jar of transition there. But the aspect of spending beyond your means is a Keynesian, it's not really a Keynesian philosophy, but economically it's a Keynesian philosophy. I think it's a human philosophy. We'd all like to spend beyond our means. But when it comes to governments, the way in which they justify spending beyond their means is to say, okay, we have this supply of value in the form of money, and we're going to run a deficit and spend beyond our means. And then under the conventional Keynesian model, when you take that deficit, you supposedly are using that to get you to an outcome that you then acquire some form of a surplus and you pay down your debt. And that's not dissimilar to anybody else or any other understanding that takes out debt and you pay it down, right? You take out a loan on your house and you go to work and you acquire the means to pay it down. And that is an equitable way in which we utilize debt to finance some form of bringing what should be a future occurrence into the present. Unfortunately, where the conventional Keynesian mindset kind of goes berserk is that under that philosophy, the good times, governments don't tend to pay down their deficits. So we accrue debt, and debt is the total accumulation of deficits year on year, piled up one after the next. And so you get these humongous debts, like $30 trillion. And that becomes problematic because now you're spending beyond your means. Whereas under a monetary standard, under a fixed standard, assuming that everyone agrees and plays by the same rules, where you can't go beyond a certain rate of debt or deficit or spending generally, then you can't increase your supply or your purchasing power exponentially as we've seen. Does that make sense?
Mm-hmm.
Okay.
So, let's try and capture a little bit more about the size of the US debt and how interest rates, do they necessarily matter even at that point when they start to go up?
Right. Yeah. No, they do. Definitely. The way I like to think about it, we've all become so numb to these numbers. Million, trillion, billion, quadrillions, septillion, sextillion, quintillion. They're all these numbers that don't really mean anything anymore, at least when we use them in our day-to-day transaction. We say a lot of the times in this community that you and so many of the individuals like you that have shows in the gold and precious metals community, the way in which the term of these assignments of numerical value are used, they become nonsensical. And they become so meaningless that we don't really recognize their impact. So I like to use this example that 1 million seconds, do you have any idea how long 1 million seconds is?
I I don't remember, but I know how much a trillion is. And I was going to ask you to define a trillion by that analogy, because I love it. I remember probably 2 years ago now when I had Mark Yusko on the show, he gave that definition. And I think it's an excellent way to kind of conceptualize how big a trillion really is.
Yeah. So 1 million seconds is 12 days, right? So it's not that long, right? 1 million seconds, a big deal. But do you know how long 1 billion seconds is? Any idea? Any guesses?
Remember. No.
32 years. So we go from 1 million seconds to 12 days to 1 billion seconds to 32 years. That's about the span of my life, right? Just 1 billion.
Hmm.
How about when we jump up to 1 trillion?
That's 32,710 years. 31,710 years.
Yeah. So I ballpark it at 32,000 years. So we go from 12 days at 1 million seconds to 32 years at 1 billion seconds to 32,000 years at 1 trillion seconds. And the US government officially is running $30 trillion. So 32,000 times 30, whatever that equates, 288,000 years of debt, right? That's officially. But unofficially, we're somewhere in the ballpark of 200 trillion. So 200 trillion times 32,000, whatever. Now, if you think about a quadrillion seconds is 32 million years. So we go from 1 million to 1 billion to 1 trillion to a quadrillion. And for us, in linguistic parlance, common day usage, these terms are meaningless. They're senseless. They just, trillion, whatever, it does, whatever. What's a trillion? Well, if you think about the derivatives market as a whole, I think it's $2.1 quadrillion. So that's 64 million years equivalent of debt that I'm not sure how you ever pay that down. How do you pay down 64 million years equivalent? I can't even begin to understand that, because the average lifespan is 100 years. So we're going to pay down 64 million years worth of debt in a soft landing. Good luck. It's unfathomable to me. Mm-hmm. So when it comes to the trillion, well, you start attaching interest as your question, second portion of your question asked. You start attaching interest to that, and you start to realize the quantity of what the difference of a percent equates to. Mm-hmm. So at 1 billion, 1%, it's manageable. But 1 trillion? A couple trillion? Maybe 100 trillion? Now all of a sudden it becomes this figure that you can't manage. So with a $30 trillion debt at 10%, that's $3 trillion annually, right? So you cut that in half, 5%, it's $1.5 trillion annually. So the US government budget annually is, what is it, about 4 trillion? And I think it's 4 trillion. Don't quote me on that, but it's a fair significant quantity that's close to that. Mm-hmm. And if you have to pay $1.5 trillion, so call it 30%, 40% just in interest, well, you can't do that, because now all of your money is just going to be paid on the interest on the debt. And essentially, once you get to the point of not being able to pay the interest on your debt, you're considered in default. And so this is one of those questions that I get to is like, okay, if the US government gets to the point where, or any government gets to the point where they cannot pay the interest on their debt and they're considered in default, is it similar to how it works with an individual? Let's say you have a car loan, you have a house loan, you can't pay the interest on your debt, you default, and the bank comes and repossesses your house or your car or whatever you've, financed, right? Well, does that work equivalently with governments? I mean, does the central bank come and repossess the country when they default? Do we become property of the central bank as a nation? Do our laws and everything that we are suddenly defer to them because we can't pay them what we owe them? These are questions that I have personally that I don't know the answer to. And maybe somebody out there does know the answer to them, and I just haven't stumbled across them yet. But when you get to that point of you've got 40, 50, 60 trillion dollars and you've got 2% interest rates, you can't afford to pay the interest on your debt. So you're equivalently in default and you're bankrupt as a nation. And we're already, the US and all, I would say all of the countries on earth, and I use that term all loosely, but I think everyone is pretty much bankrupt. And so who are they beholden to? And that's the big kind of outlier question that I think nobody wants to really look at, is who are they beholden to? Are they beholden to individual investors? To some extent, yeah. Are they beholden to corporations? Sure. But like the central bank holds, 20% of the US debt? That's a big entity of power that holds a lot of influence and sway over a very, very large, the largest and most powerful government on the planet. So when they go into default, what happens?
Mm-hmm. And when you're saying that all of these countries are, for all intents and purposes, ready to default, it makes you think about what piece of value is going to be left at that point. And that's why I think a lot of these roads come back to gold, because you see countries that have, the debate could be made one way or the other, whether these systems have advantages or disadvantages over the US or Canada or these democratic countries, quote unquote, democratic countries. But if you look at some of these Eastern Bloc countries like Russia or China that have been stockpiling gold, because, let's just assume that they understand this problem of this global debt problem. A lot of these countries that have this more long-term vision have been stockpiling gold. So, when they have that ability to have something, to go back to a type of money that has stood the test of thousands of years, and they also have a lot of these resources to help feed and keep their societies flowing with energy, it really makes you think what types of value placeholders are going to be left once this insane system of derivatives and debt comes to a head.
Yes, absolutely. I mean, spot on 100%. And I think it leaves a little bit of an open-ended question of, is gold the place that we return to? And if it is, okay, and hopefully something similar to it, if not gold. My philosophy is more that money is that measuring stick. And so regardless of whether it's gold or not, gold, the reason you say it stands the test of time, and I think this is really similar to the million, billion, trillion, quadrillion thing in terms of seconds and the meaningless understanding of these terms and why they kind of get overlooked. You say it stood the test of time for thousands of years, and why that's important.
Just as being used as money at very least, right?
Well, yes, but why specifically gold? Or I like to quantify the 5 platinum group elements as being essentially interchangeable. And whether we assign rhodium, platinum, palladium, silver, and gold as being interchangeable or not, we can focus on just gold. But why gold? Why is it like, do you know why specifically we choose that as the thing that acts as that representation for the yard or the metric or the measuring stick?
Well, I think it serves several different purposes, but let's say the most important parts are the very stable nature of it and the rare nature of it.
Yeah.
Chemically stable.
Yeah. And that's really, that is what I tend to focus on as being the most important criteria. We don't think, because our lives are so short, and I say short being 100 years. If we lived thousands of years, things would be a little different. But when you build a house, it lasts without needing any kind of renovation, maybe 60 years. When do you have to put a roof on? When do you have to, you have a car? When do your tires wear out? Your clothes only last a couple of years. You need to put new shoes on. What can you really think of that lasts physically? And so if you're transacting in something that deteriorates due to entropy, the state of returning to the natural atomic position, then what are you using? Because if we're transacting in tires that wear out over the course of a year and you need to buy new ones, that's not a very stable metric by which you constantly have to generate new tires to constantly keep up the circulation of that money or that medium of exchange. So these 5 platinum group elements are the only known elements to humanity that exist that do apparently have there's no effects of entropy to them. They don't break down. They don't wear out. If you rub them, like if you're circulating gold and your hands are constantly rubbing the coins, yeah, a little bit of it's going to tarnish off or wear off. But for the most part, if it's left untouched, it doesn't break down. And there's nothing else on the periodic table of elements that does that. No gases. I mean, gases need to be contained in forms of, I'll say, cylinders. You need a propane tank to contain propane. Otherwise, it just vents to atmosphere, right? And you can't contain it. It's also very difficult to transact in that. I mean, you're going to have to store it somewhere that you're going to have to, I mean, it's the difficulties associated with exchanging in gases, not great. The physical chemical aspects of things that we do know, like lumber or metal, just conventional metal, or any of the physicals that we know of, they break down pretty quickly. And the radioactive elements, obviously not great to work with. So how do you determine something that, as you said, stands the test of time? And when we say that it's, one of the things I've been listening to your show and so many shows like yours for so long, and I hear this over and over again, that gold has stood the test of time for 5,000 years. And I think the key part of that often gets overlooked is that, why has it stood the test of time? Has it stood the test of time because people keep using it? Or has it stood the test of time because it actually stands the test of time?
So, Jess, I want to go back to something that we kind of touched on, and that's the idea of the Federal Reserve. So do you think that there is a role that the Fed still is necessary for in today's world?
Personally, absolutely not. From a government, I mean, there are 90 angles associated with this question. So there's no easy way to answer this. And that is because there are the type of structure governmentally that you operate under, the type of structure economically that you operate under, the type of structure societally that you operate under, the type of structure religiously potentially that you operate under, the type of structure monetarily that you operate under. And all of these things are turning on each other, and you can't have one without the other to some extent. And it basically becomes an impossible extrication of the central bank as this core feature because of the types of structures that we choose presently to utilize. And until we change the types of structures that we exist under, if we operate under a governing model, and I say governing, in the interview with Chris Marcus, I used the Nolan chart. David Nolan was one of the founding members of the libertarian movement in, I think it was the 1950s, 1960s. The whole construct of that Nolan chart is to identify where your political and economic liberties meet. And how you determine that determines what type of socio-political economic structure you exist under. And due to that economic, political, social structure, then you can ask that question of, does a central bank play a valid role, or do we need it? And in the current structure, we absolutely do, because without it, you're just going to have, if you turned it off, let's say we shut down all the central banks today, you just have mass pandemonium, chaos. No one would know what has the means. I mean, maybe I don't give humanity enough credit. Maybe I'm a little too pessimistic, and maybe I don't believe that the ability economically to transact, that people have been under the structure of direction by governing agencies for so long that they wouldn't know what to do, and it would devolve into mass pandemonium and chaos. Maybe it wouldn't. But I think that given the opportunity, people tend to want to choose chaos immediately That's why riots they get out of hand so fast, because it's so easy to devolve into that. But with today's structure, you can't have the types of governing agencies and the social structures and the political structures and the economic structures without having that, what most people view as that backstop of a central bank kind of guaranteeing purchasing power. And until the reintroduction of actual money is no longer bastardized by the pseudo version of money, which is the central banks standing in place of that, it's kind of like the evil version of money. It's Bizarro world. Like it's Superman Bizarro, right? Like he's not Superman, and money is not money. It's this evil, twisted, messed up version of this thing that's supposed to be money that isn't, and it pretends to be, and it's got all of the powers and controls that money does have, but it's being used and allocated in ways that cause all sorts of harm. And I don't know how you disassociate and disentangle, at least immediately, without addressing all of the other constituent parts that I mentioned with the social structures and the economic and the political structures. I don't know how you disentangle that element of the central banks and the Federal Reserve from the current existing structures, because I just think it would devolve into chaos, because most people aren't economically literate enough. Maybe I don't give enough credit where credit is due to be able to transact. I don't know how you walk into a grocery store without dollars or the medium of exchange, the currency. If the Federal Reserve and the central bank suddenly capitulated overnight, how you walk into a grocery store or anywhere and say, hey, would you be willing to accept this as a medium of exchange? And that devolves into essentially barter. And barter has the issue of the double coincidence of wants, where you have something that someone else doesn't want and they have what you want. And in order to get what they have, you have to go to someone else first to get what they want, and then bring it to them or transact with that person first, and then go to the person that you want to exchange the thing that you actually want, the item that they have. And that essentially equates to the double coincidence of wants. So you can't, how do you disentangle? The only way is to theoretically retroactively go back to a sound monetary standard. But the way in which Keynesianism, again, it's always Keynesianism. And man, I wish Keynes could be alive today to see the horrors that he created, because I think he would be so ashamed of who he was historically and how his ideas were, again, bastardized, because I hope that he wasn't thinking that this was what would happen. But because of the way in which it has, the tentacles of Keynesianism and debt, or the modern debt system, have attached itself to our current socioeconomical political structure, there's no easy way to let go of the Federal Reserve and the central banks. I don't know how you do that without, again, turning around and going back to a sound monetary standard. And the only way you're going to do that is to get people individually to stand up and say, we want a sound monetary standard. We no longer want to play this fake lie of a game.
So I want to go back to something, J.E.S, that we were kind of talking about earlier, and that's this growth in the currency supply. So how much currency was brought into existence during the reaction to COVID, let's say, like basically in the last 2.5 years?
Yeah, I mean, what they tell us is 5 trillion, right? Give or take 5 trillion from the U.S. central bank. And then you can figure every other central bank on the planet injected their own equivalent variation or amount of that.
Let's just stick with the U.S. for now.
Okay, so yeah, I mean, they say 5 trillion with additional injections here and there, but I doubt that that's anywhere near the actual total, because there's so much. A lot of the bills, I think, that they set up in terms of the spending packages that they write into law, they're contingent on future spending. So you have to account for that. And if you don't, then you're not really accounting for what was injected, because you're accounting for the initial injection and only that, right? And so, like, Peter Schiff, again, I love Peter Schiff, but he calls it monetary heroin. And if you get an injection of heroin and you're thinking, okay, this is the one-time use of this, okay, cool. And if that's it, great. but what are the odds that that's it? So on its face and on the surface, the immediate answer to your question is approximately 5 trillion.
Okay.
But I would say probably closer to 50 trillion.
So what kind of consequences does this growth, not necessarily just in the last 2.5 years, but what consequences does this growth in the currency supply have? Could the milkshake theory prove right?
Brent Johnson is, geez, man, that whole theory is it's so weird because it's all predicated on the notion that the dollar is the reserve currency of the world, and the reserve currency basket, the DXY, is specifically set up to empower the dollar. So yeah, of course he's right? Because of that, because the game is rigged, because it's set up to no matter whatever they want to have happen will have happen. So if they want the dollar to be strong, they've got the quantities of that basket of the relative strength of the dollar to other currencies that they arbitrarily pick, right? Why is the basket not every currency on the planet? And personally, I think it should be. You know, it's unfair to arbitrarily choose 5 or 6 currencies and say these are the ones that we consider as being equitable and the ones that we're going to balance our value against. That's bullshit. And it's picking winners and losers at the behest of making sure that you, as the dollar, as the reserve currency, stay on top. So as debt is issued in dollars to other countries by the United States, the demand for dollars by those countries exists, and they have to come up with the means to pay down that debt in dollars, right? So Brent Johnson's milkshake theory is, I listen to it and I go, yeah, but you're ignoring the component parts of it that dictate and predicate that it's going to happen that way no matter what, because that's how it's rigged. So of course, like, all essentially that he's done is point out what is and say this is going to happen because it's going to happen. Of course it is. Do I agree with it as a theory? No, because it's all skewed in favor of that riggedness, right? So if we were to allocate the correct balance of value in the basket of currencies as being equitable and fair and honest, and we accounted for every currency on the planet and its actual value. And when I say currency, I mean, what are we really talking about? Are we talking about the value of some piece of paper, or are we talking about the value of a country? And are we encapsulating all of the component elements of what that value equates as? Are there certain countries that may not have commodities, but they have a really ambitious group of people, like Germany, right? Germany is a very industrious economy. I mean, I'm sure they have their resources, but they rely on a lot of imports, as we're seeing, as far as the energy side of things goes, in order to function, right? So they're a very powerhouse-oriented economy because of their industriousness. Well, then you look at Russia, and they're a very commodity-heavy, non-industrial. I'm not saying that they're not industrious, but compared to Germany, they may not be as equivalently similar. And so how do you allocate the value of a country? How do you look at a country and say, okay, these countries are valuable? And how many countries are in Africa that just get ignored? How many countries are in Eastern Europe that get ignored? How many countries are all over Asia that get ignored, that have all of this economic potential, but are being suppressed due to the dollar, right? So we're not examining all of the constituent component elements that go into the dollar milkshake theory as being an honest, transparent adjudication of it as being relevant. And I think that it does a disservice to anybody that listens to his milkshake theory saying, yeah, it's correct, because you're missing 90% of why it is theoretically correct.
Mm-hmm. Yeah, it'll be interesting to see. And I think, again, it's a specific scenario over a specific timeline of how and why that plays out. But I kind of want to get back to, let's say, more of the theory of money here. So, let's say after 2008, we saw many years of quantitative easing. So why didn't that result in hitting the Fed's inflation target? And how silly of an idea is it to have, let's say, a 2% inflation target?
How silly. So when you say, yeah,
when you say you have an inflation target of anything, you're basically claiming that you want your purchasing power to fall, right? And you're stating that we want to lose our ability to acquire goods or services over a period of time by a certain percentage.
It sounds dumb to me, but then again, they justify it by offsetting the growth of a nation, right? So if your country grows GDP-wise by 2% and your inflation rises by 2%, and they both exist annually, then you have an inflation rate essentially of zero, right? I think that's their justification. That's how they look at that and they go, yeah, it's not actually inflationary because we're growing by 2% and we're inflating by 2%. So we're really not moving at all. But growth doesn't necessarily equate to, at least in the way in which we grow. I mean, if you look at US GDP, how much of US GDP is spending, right? So if you're spending what you don't produce, or you're spending, how do I say that differently? You are transacting in a medium of exchange that equates to purchasing power that you acquire goods for that you did not create, then you're running a deficit, right? Because that's essentially what that equates to, right? You're spending what you don't have to acquire what hasn't been made. Mm-hmm. And that equates to a deficit. So if your GDP, what if it's 30%, 40% of your GDP is wrapped up in spending, then you've got a distorted view of growth, right? Because you're growing by spending. I challenge anybody to not produce, have zero income, and then go grow by spending. I don't know how that equates to success. Yet somehow the distortion of that results at the United States growing in terms of growth as GDP by spending. And they get to do so because they're the reserve currency of the world. They issue dollars in the form of debt and they exchange it for goods. And then those dollars are recycled into treasuries by those countries who then get a portion of interest, which then they get paid and then can exchange into their own currency and theoretically create a profit, right? So like that's how the justification of why the reserve currency has been able to sustain and prolong itself for as long as it has. But once you start increasing the rate of inflation, the loss of purchasing power, that argument becomes nullified because you're now, when you recycle back into treasuries, you're losing purchasing power because of the rate of inflation, right? So if you're getting 3% interest rates, but your rate of inflation is 9%, you're losing 6%. So if your currency is already worth theoretically less than the dollar, and you exchange back into your currency and you've already lost 6% on the front end, and then you exchange into your currency, which is worth less, how are you benefiting? I mean, maybe I'm missing something there. And maybe I'm not an expert at exchange ratios and those get wonky in my head. So I do apologize to anybody that can see that more clearly than I can. But to me, that makes zero sense. And if you're a country that is selling stuff, like let's take China, for example. China is basically producing infinite goods at slave labor, right? You've got people working 21 hours a day in these factories. They've got suicide nets outside because they can't take what they're doing. And these corporations are paying them little to nothing, equivalently to the value of what it costs to live. I mean, not so much anymore, but for a while in the first, couple of decades after the end of the Cold War, that's what we really saw in China. And essentially the premise, I think, for China was they were selling $1 for 10 cents, right? They're making it up on volume. They got huge customer base and they can create all of this demand because they've created all of this supply, right? And a Keynesian mindset is you create demand and that will stimulate supply. And that's absolutely ludicrous because you cannot consume what you haven't produced. But the concept that the Chinese, in this case, can produce a whole bunch of stuff at slave labor, export it, and then lose money on it, I don't get it. Personally, it doesn't make any sense to me. Because at one point it was working for them before the United States injected all of their dollars into the QE component. And like I said, I'm talking in circles and I do apologize for that. But again, there's no easy way to discuss this. The QE component of it, you've got injections into the financial economy. And as I said on the interview with Chris Marcus, the reason that inflation didn't
go where so many expected it to was because that money, the currency that didn't circulate in the real economy, it stayed in the financial economy, it stayed in the stock market, in the bond market, and it kept treasuries, it kept the interest rates low, which kept the affordability of borrowing low, which allowed access to capital more easily, which allowed companies to leverage, which allowed them to do as they would. And I'm not every company, so I can't speak to how they chose to allocate their resources, but I think a lot of them misallocated them improperly or misallocated them properly, depending on how you would quantify that. But they did all this, and all of that money stayed in the financial economy. And anybody that looks at the Dow Jones over the last decade and a half sees inflation. You can't look at that chart and not see inflation, right? So inflation did happen. It just didn't happen in the price of consumer goods. And that's kind of a skewed way of looking at inflation, I think, because picking sectors and saying, oh, we have inflation here and we have inflation there, you're not identifying, again, the core definition of inflation as being an increase in the quantity of the currency supply, regardless of whether certain sectors went up in price, doesn't really matter. It does have a knock-on effect. There is a downstream effect of how that works out. And as we've seen, now we know what those knock-on effects are. We saw a liquidity crisis in 2019. We saw the repo market potentially just say the banks were liquid and they needed to inject a whole ton of capital. And now you've got the reverse repo market where banks are parking capital and liquidity overnight rather than lending it out because it's safer, because they're not going to lose it. It's just a web of so many intricate components that there's no way to effectively tackle any of them. I don't know if that answered your question, but as far as the silliness of QE, it is a little ridiculous because the idea is that you can jack yourself full of heroin and that you're going to be okay, first of all, and that you're also not going to then need more later. Mm-hmm. And that eventually the heroin kills you, right? Eventually you're going to overdose. So the same is true for the injection of currency. At first, it's, enough to keep you alive. And if we're at the point where the injection of currency is the equivalent of giving morphine to a dying patient, then we should probably acknowledge that we've got a dying patient instead of acknowledging that we need more morphine.
Absolutely. So to kind of wrap all this up, how do you see the path forward for inflation for, let's say, the next decade here?
Well, Luke Gromen is definitely by far one of my favorite economists. And I think he does a really good job of trying to predict that, where he says that the United States will inflate significantly for the next decade to try to get its debt to GDP down to a manageable level where it can then start printing again. Maybe, maybe not. I don't know. I mean, Luke's a really smart guy and he really gets this stuff. I don't know if that's going to work because, maybe it does. Maybe enough people have enough currency, enough purchasing power to withstand the loss of their means of exchange to be able to acquire their need to go on day to day for a decade. I don't. Personally, I can't withstand that. And I don't know how a lot of people could. There's a lot of money out there, I guess. So if the central banks think they have a mathematical equation to figure that they have a debt problem with governments and they need to get their debt to GDP under control, and they figure that enough people can withstand losing purchasing power because they have this amount in their bank account or in reserve assets or whatever, and they can withstand taking the hit, then they can justify continuing to inflate. If they value that a certain quantity of people are going to be able to withstand that rate of inflation. Mm-hmm. I think that's how they perceive it. They figure if a large enough percentage can manageably take that kind of hit, then they can get away with it. I don't know how that works because, again, as you inflate, you have your debt problem. And the only way that you can pay the interest on your debt, once your debt continues to grow exponentially as it has to, you start needing to pay down your interest on your debt. And as you inflate, you have to print. Well, as you have to pay that interest, you have to inflate and print to pay that interest, which causes further exponential rise in inflation, which then devalues your current, you get hyperinflation, right? But my position isn't necessarily
hyperinflation. I believe that we're entering a hyper stagflationary depression, which supposedly isn't possible. I mean, stagflation in itself under the Keynesian model isn't possible, but a hyper stagflationary depression seems irrational on its face again, but I don't think it is, because you can't generate growth with the issuance of further debt because of inflation, which causes prices to rise, which cause, your producers have higher costs to pay, which means they can't produce as much. As inflation goes up, interest rates have to go up to theoretically fight inflation. As interest rates go up, the ability for corporations to leverage debt against their costs goes down, which means they can't borrow as much, which means they have to shrink. So you get the kind of deflation. It's not deflation. It's a depressionary kind of stagflation, but you also have that rapid increase of quantity to fight your debt to GDP, right? It's that corner that we always talk about as being the Fed is backed into. There's no easy way out of it. And I think rather than doing anything, they'll just do what they're doing and we'll all just suffer and we'll just get a hyper stagflationary depression, I think.
Mm-hmm. Because wages can't grow along with the inflation in that environment, right?
Right. Because if your wages go up, then you have that wage price spiral, or as again, Peter Schiff likes to call it, your price spiral, because wages are prices. There's so much of economics that is not well understood by the mass public. And when people say, oh, wages aren't rising with inflation, you're basically saying prices aren't rising with prices.
Mm-hmm. The price of someone's labor.
Right. Because somebody has to pay that wage, and that's a price to somebody. So they have to pay that price. And in order to offset that price, they have to raise their prices. And so if you increase the price of labor or wages, then more people have more purchasing power, which means they're going to go out and buy more stuff, which is going to cause the velocity component of your inflation to increase, which is going to cause the appearance of the circulation of currency to seem to increase, which is going to cause prices to go up. So in no way can wages ever keep up with rising prices. And when we say rising prices, we mean rising commodity prices or rising consumer prices, right? So no, it's just impossible. It's a financial doom vortex nobody can ever get ahead of. Does that make sense?
Mm-hmm.
So yeah, no, I don't see how in any way that wages could ever keep up with prices.
Mm-hmm.
The only way to effectively fight that is you have to increase your production. And in order to increase your production, you have to increase your productivity, right? A person that is employed as an employee or a worker with their labor, in order to be beneficial for an employer or a business or whatever, to be able to drop their prices, you as the employee has to be more productive, giving your employee the means to lower their prices and pay you more potentially because you're being more productive. You can produce more, they can sell more, and they can drop their prices because they don't have to pay you as much for less productivity, and you get more purchasing power and there's more stuff to buy. So you increase your supply of goods, your bottom line as the wage earner goes up. And theoretically, if everyone's increasing the supply of productivity or the production, you have a reduction in prices. So that's the only equitable way that I know of to fight the wage price spiral.
Mm-hmm. So J.E.S, is there any other points of inflation that you want to address here, maybe before we wrap up?
Yeah, I mean, there's so many components of this, but I think the one that kind of gets lost in translation is so much of this is built. I finished with the Arcadia Economics interview with the Nolan chart, and I don't want to exactly do that here, but the whole money system, it always exists under an economic system and a socio-political economic system. And the freedom component, you can't have what we envision as, prosperity, I guess. I'm not everybody and nobody is, so none of us can really see the view of the world through the eyes of another. But I think a lot of us grow up, at least. I think if we were to talk to our 6-year-old or 10-year-old self, we would all think that everyone kind of deserves
a similarity of fairness, and nobody deserves, the 1% holding 75% of the world's wealth. None of us look at that and go, yeah, that's a good model of how we should balance the resources of the world. And so I think if we're honest with ourselves, we look at the world in terms of wealth and how do we get to a point where everything is not so expensive? We have what we want, and we are able to do it equitably in a world where nobody is suffering due to the oppression of some business or government or corporation or lobbyists or whatever it is, or central bank, that causes this kind of beggar mentality of you're working for pennies on the dollar of your actual valuation in order to earn a living, to go out and to acquire the things that you need to sustainably exist in this world. And the part that often gets missed, I think, is the freedom component and the reality and awareness that you're not actually free. You think you are. You live in a world where you believe you have freedoms, and you believe that your rights exist, and you believe that the lie of the matrix that you've been told is true. You believe that everything about your world is true. And I include a number of links. One of the things about my books, you said in the beginning that my book is a little unconventional. It absolutely is. And that was kind of the point, that everyone uses, not everyone, but a good enough majority of people use the digital world as a way of acquiring information. So I figured, hey, why not integrate that? So I use a lot of videos via YouTube in the book, and a number of them touch on freedom. And one of them is from a clip from, I forget what the name, it's The Newsroom, I think is what it's called. And I always forget the actor, but he talks about how so many countries have freedom and what makes the United States the best country on earth. And he says it's not. And not only is it not, then goes on to say that every country has freedom. I don't think they do. You have the freedom to not be arrested for walking outside. Oh, wait, COVID. No, you don't. I mean, really, if you examine the truth of what you actually have the freedom to do, you don't. There's so little actual real freedom. And because of that, you accept the lie of currency. You accept the lie of inflation. You accept the lie of whatever governments tell you, because you believe that you're free, and you believe that what they're telling you comes from a skewed iteration of freedom that somehow manifested where these leaders were honestly and equitably assigned these roles of power to make decisions, and they weren't. And so when they get to the point of being in power and they make these laws that then allow for things like currency to exist, that then causes inflation, because of course it does, we just go along with it because we believe we're free. We're not fighting against it because we're fighting the wrong thing. We're spending our time fighting inflation when we should be fighting the lack of freedom. We're treating symptoms, not causes. And as long as we continue to treat symptoms and not causes, we're going to get the wrong outcome. And inflation will persist. All of the component elements that go along with the subjugation of this 21st century version of slavery that we all exist under, which is the currency debt slave system. As long as we don't fight against the cause effect, we will continue to get more of it.
Yeah, I think that's a good place to wrap up there, Jess. Fighting against the cause and effect, or at least even understanding it, that's important. And I hope we've helped some people understand that a little bit more today.
Yeah, I hope so too. I mean, I know it's really difficult. I know that I'm not the easiest person in the world to listen to as far as my language goes and my usage of it. It's a really difficult topic, and there's no easy way to translate it. And that's one of the things that I address in the book, is that language in itself is rather primitive, at least the spoken word, because we're so bound by the laws of language in order to effectively convey so much information, which this theoretically is. I mean, we're dealing with the equivalent of like gigaterabytes of information. Like, it's so much information, and it has to come out one word at a time in the correct order. And it has to be invigorating and entertaining enough for you to want to listen to it. And I have to be good enough
at speaking it to be able to convey it. And so much of that gets lost. I think 90% of communication gets lost in language because of the primitiveness of language itself. And so I do apologize to anybody that, kind of got lost. I'm not by no means a professional speaker, and, it is what it is, I guess, at the end of the day.
Yeah. Well, I'm sure we'll have some good feedback and some not so great, but that's okay. Each speaker isn't meant to talk to every single person, but I do appreciate your time and your understanding of the subject. Where can people find your book, J.E.S?
So right now it's on Amazon Kindle, and that's the only place it is. I'm trying to get the paperback version of that uploaded. I don't know how familiar people are with Amazon and Kindle, but their formatting system is really bad. It's really not meant for any modern technology, I guess. It looks like it's something out of the 1970s. So the formatting of the book on the Kindle is not as I wrote it. And so there are some things that don't directly translate. There are some images, like some emojis that I used in the book, that the symbols did not translate in the book on Amazon Kindle. So I apologize for that. I'm trying to figure out how to make that more applicable to what it's supposed to be. I also, as far as the price goes, I put it at the lowest price that Amazon would allow me to, because I want this book to reach as many people as possible. And it's not about making money on it. So if you're used to seeing books at a much higher price and you look at the price and you think, why is that so low? It's mostly because I want to get it in as many hands as possible. Mm-hmm. So for now, it's on Amazon Kindle. I'm going to try to get it on in paperback. And it's The Real Truth About Inflation. And, honestly, if you purchase the book, you can email me. And if you want, I'll send you a PDF copy of the actual book, so you get a genuinely originated formatting of the book. It's AU Econ.J.E.S. It's AUECONJES at gmail.com. And if you send me a receipt of your purchase on that, I'll send you a PDF of the original formatting so you can get it as it was written.
Awesome. Thanks so much for your time today, J.E.S. Really appreciate it.
Thank you. Thank you so much, Tom. It's been a real pleasure being able to talk to you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.